Nicolas Darvas was not a financier operating from a Manhattan skyscraper. He was a professional ballroom dancer, perpetually touring global capitals, physically remote from the very markets he sought to profit from. Conventional trading logic demands proximity, a constant feed of data, rumor, and consensus. Darvas had none of this. He worked exclusively through telegrams, receiving price updates hours, sometimes days after the transactions occurred. By all probability models, this forced delay should have been a catastrophic disadvantage. Yet, in less than 18 months, Darvas systematically transformed an initial capital of $25,000 into a documented $2.25 million. This extreme asymmetry demands analysis. The key to his success was that his remoteness functioned as a mandatory systemic filter. If you are thousands of miles away, you cannot hear the noise. You are forced to focus solely on the signal. Darvas was unable to participate in the psychological drama of the trading floor. He could not react emotionally to the hourly fluctuations, nor could he panic sell based on a rumor overheard in a brokerage office. His method, a rule-based system of buying only when a stock broke out of a defined price range, was not just theoretical. It was enforced by the mechanics of his communication. The delay between his decision and his action created a necessary condition for absolute objectivity. The system became the barrier against the most damaging variable in finance: human intuition. He built a probability engine designed to capture pure momentum without the interference of fear or hope. Darvas proved that the edge is often found not in proximity, but in the disciplined application of distance. Before we continue and get to the main point, I'd like to thank you for the interaction that drives this content. If possible, take a second to subscribe, like the video if you enjoy it, and leave a comment. This helps the video reach more people and guarantees you won't miss the next breakdown. The greatest variable in any market equation is human emotion. If you seek to quantify speculation, you must study the principles of patience and rigorous observation. For the foundational text on this discipline, we recommend Reminiscences of a Stock Operator by Edwin Lefèvre. This book is a clinical dissection of market psychology, trend following, and the absolute necessity of timing. It treats speculation as a scientific endeavor, demanding emotional detachment and systematic weighting. Master the discipline before you master the trade. The link to this book is in the description below. To understand this necessity, we must first examine the inefficiency that preceded it. Like many entrants to the market, Nicolas Darvas began his journey burdened by the weight of external opinion. He consumed the prevailing noise, the broker tips, the cocktail party rumors, the confident assurances delivered by those who claimed insider knowledge. He attempted to integrate these external signals into decisions based on traditional fundamental analysis, studying annual reports and balance sheets in detail. But this approach yielded only frustration and capital erosion. The information was always lagging. The hot tip was invariably priced in by the time it reached him, and the detailed fundamental research required a static, deep focus incompatible with his primary career. His initial strategies were reactive, subjective, and reliant on proximity to the source of the data, which was a resource he simply did not possess. Darvas was not a stationary observer. He was a touring professional dancer booked across continents. His office was a hotel room in Paris one week, Tokyo the next. This extreme physical distance was the crucible for his eventual success. Consider the logistical impossibility of executing emotional or reactive trading from a remote location in 1957. There was no instant digital feed, no immediate access to a desktop terminal. He could not sit and watch minute-by-minute fluctuations. He could not phone his broker 3 times an hour to debate a rumor or react to a sudden dip. The physical constraint eliminated the possibility of human interference. The fear that forces premature selling, the hope that prevents necessary liquidation. Distance, in this case, became the ultimate filter against the signal-to-noise distortion that plagues active traders. The system he required had to be self-contained, requiring only two objective inputs, a buy trigger and a sell stop. These triggers had to be mathematically defined, based solely on observable price action, and reducible to a simple coded instruction that could be relayed across oceans via telegram. The telegram itself became the constraint that enforced discipline. You cannot effectively convey nuanced sentiment or a vague gut feeling in a 6-word coded instruction sent internationally. You can only transmit objective, actionable directives: buy X at Y, stop loss Z. This mechanism forced objectivity. It systematically eliminated the fundamental noise, the earnings reports, the management changes, the geopolitical anxieties, and focused solely on the market's consensus verdict, translated into pure price momentum. The Darvas Box system was born not merely from intellectual curiosity, but from the brutal necessity of operating a high-probability system while physically disconnected from the very market it sought to exploit. It is an engineering solution to an emotional problem. This mechanical system requires us to discard subjective assessment entirely, replacing it with quantifiable criteria. The Darvas box is not a drawing on a chart. It is the algorithmic crystallization of market intent. If the objective is to capture the momentum of an asset already in motion, we must first define the precise parameters of its temporary pause. Momentum by its nature is fundamentally cyclical. It exhibits sharp impulse phases followed by necessary periods of consolidation, where the market digests the recent move and rebalances supply and demand. We are searching for a specific, repeatable signature within that consolidation. A zone where selling pressure is systematically absorbed without invalidating the prior upward structural integrity. This absorption zone is the box itself. The construction begins with the identification of a new price apex, which we designate as high H. For this high to be validated as the potential upper ceiling of the consolidation structure, a specific, logical condition must be met over the subsequent trading sessions. The defining rule is absolute. The high, H, is confirmed as the ceiling if, and only if, the price fails to register a higher high for 2 consecutive trading periods immediately following H. This 2-period confirmation acts as a critical algorithmic filter. A single day's failure to exceed the peak might simply be transient market noise. 2 consecutive failures signal a probable structural shift in short-term upward velocity. It objectively indicates that the immediate pressure which drove the stock to H has temporarily neutralized. The probability of an immediate continuation is therefore reduced, suggesting the asset is entering a phase of horizontal equilibrium. The market is communicating that at this moment, the price level H represents the maximum tolerable valuation before a period of cooling is required. Once the upper ceiling is established by this mechanism, the system searches for its reciprocal boundary, the lower floor. This floor is defined by the lowest price achieved during the period after the initial high H was established, but before the stock breaks out to a new high. This boundary is not arbitrary. It represents the maximum acceptable retracement by the controlling interests. Just like the ceiling, the floor must be rigorously confirmed by the system's logic. The low L is confirmed as the box floor if, and only if, the price fails to register a lower low for 2 consecutive trading periods following L. This dual rejection acts as the objective proof of support. It demonstrates that selling pressure attempting to test the lower boundary of the consolidation range has been decisively rejected by buyers for 2 sequential sessions. The market is signaling that the current price level L holds sufficient intrinsic value for participants with the requisite capital to absorb all available supply at that point. The resulting structure is a precisely defined rectangle of price action. It is not merely an arbitrary range. It is a clear analytical statement about the current state of market tension. Scientifically, the box is the quantified footprint of institutional accumulation or controlled distribution, depending on the preceding impulse. In this context, the box boundaries serve as control points. They prevent the price from prematurely exceeding the upper ceiling, and they rigorously defend the lower floor, as a breach below L would invalidate the current thesis of upward continuation and momentum preservation. This mechanical approach removes the ambiguity inherent in qualitative support and resistance analysis. We are not guessing where the structural lines should be drawn. The market draws them for us based on two simple, non-negotiable criteria: 2 consecutive failures to advance and 2 consecutive failures to decline. The box represents a state of high controlled tension. The energy is coiled and contained. The volume profile within this zone often confirms the underlying thesis. High volume on the initial establishment of the box boundaries, followed by diminishing volume as the consolidation matures, indicating that the available supply has been effectively contained and absorbed. The system is now primed. The only remaining variable is the catalytic force required to break this probabilistic equilibrium and initiate the next high-velocity impulse phase. The initiation of that high-velocity impulse phase requires a definitive mechanical validation. It is not an emotional guess, but a logical calculation based on the prior structural containment. The Darvas system defines this validation through 3 interlocking criteria, designed specifically to isolate true momentum signals from the inherent noise of the market. The first rule is the fundamental structural requirement: the entry trigger. After a mandatory period of price containment within a defined box, bounded by the upper ceiling and the lower floor, the security must definitively trade above the upper ceiling boundary. This is the calculated moment of structural failure for the consolidation pattern. The ceiling, which previously acted as the primary resistance level, now fractures. This breach signals that the prevailing supply at that exact price level has been fully absorbed by demand, clearing the path for movement. The system is engineered to enter only when the price is actively demonstrating escape velocity, ensuring that capital is deployed at the moment of maximum potential efficiency and minimum structural resistance. However, a mere price breach is insufficient for a robust trading system. The marketplace is saturated with false signals. To filter this noise and confirm a genuine, high-conviction move, we introduce the second criterion: volume confirmation. For the breakout above the upper ceiling to be considered a valid signal, it must be validated by a significant, measurable expansion in trading volume. This volume surge acts as the quantifiable fingerprint of institutional commitment. If the price breaks the ceiling on minimal volume, it suggests a temporary anomaly, easily reversed by existing supply. Conversely, if the trigger is accompanied by volume substantially greater than the recent average, ideally 50 to 100% above the daily volume metric established during the prior consolidation box, it suggests that serious coordinated capital is actively forcing the breakout. This is the necessary asymmetry. The price tells us what is happening. The volume confirms who is making it happen. The third criterion addresses the inevitable presence of risk, transforming uncertainty into a defined mechanical variable. This is the trailing stop-loss rule. The moment the entry is executed, the protective stop must be immediately placed at the floor of the box structure that preceded the entry. This precise placement is critical because the preceding box floor represents the last definitive level where major support held during the consolidation phase. If the price were to fall back below this floor, it invalidates the entire premise of the breakout. The accumulation phase has failed, and the upward momentum is structurally aborted. The system dictates an immediate, predetermined exit to preserve capital. Crucially, this stop is a one-way mechanism that defines the core asymmetry of the strategy. It can only be raised. As the security successfully breaks out and subsequently forms a new, higher box structure, by establishing a new higher floor and ceiling, the stop is mechanically moved up to the floor of that newly established box. It is never lowered under any circumstance, regardless of temporary volatility or retracement. This discipline locks in realized profits automatically as the trend extends, while simultaneously guaranteeing that the initial risk exposure is protected. The system ensures that the maximum potential loss is defined and immutable at the precise moment of entry, while the potential gain remains structurally unlimited. A logically sound system often generates a profound psychological vacuum. If the mechanics of risk asymmetry are structurally perfect, why does the execution frequently collapse under the operator's hand? The answer lies not in mathematics, but in the internal human wiring that resists the required discipline. The Darvas methodology is fundamentally a strategy of extreme inactivity. It is a filtering mechanism designed to isolate the rarest of market events. Stocks demonstrating both persistent institutional demand and clear identifiable price stability. This means the operator must possess the psychological fortitude to ignore 95% of all market activity. The human brain is wired for action and immediate feedback. It interprets prolonged inactivity as failure or missed opportunity. The system demands that the trader sit motionless, treating the vast majority of market fluctuations as irrelevant noise. The discipline is not in the trade selection, which is purely mechanical, but in the waiting. This required abstinence creates the first major psychological conflict. The operator feels compelled to act, to optimize, to intervene, precisely when the system demands absolute silence. When a valid signal finally emerges, the psychological pressure intensifies. We encounter the phenomenon often termed the vacuum effect. This occurs when the stock breaches the ceiling of its established box, triggering the mechanical purchase, only to instantly reverse course, retreat, and fall back below the trailing stop loss, often within hours. Subjectively, this feels like an error, a systemic failure, or a betrayal by the market. Objectively, it is a programmed cost of the strategy. No probabilistic system can ever achieve a 100% success rate. The Darvas box is designed to identify high-probability asymmetries, but it must necessarily generate false positives, signals that meet the entry criteria but fail to sustain momentum. These false breakouts are systemic friction, and the tight mechanical stop-loss is the engineered mechanism for discarding them efficiently before they can erode significant capital. The stop-loss functions as the critical psychological firewall. It prevents the operator from engaging in narrative creation, the dangerous process of rationalizing a failed trade through hope or emotional attachment. When the stop is hit, the signal is invalidated and the position is liquidated immediately without debate. The system forces the acceptance that a failed signal is merely a data point indicating the probability distribution was momentarily misaligned, not a personal failure of intelligence or research. This mechanical precision is the ultimate antithesis of intuitive trading. The system mandates that the operator treat the inevitable small, frequent losses as non-negotiable tuition for accessing the rare, explosive gains. The operator's primary task is to maintain the systemic integrity, to ensure that the magnitude of the loss is fixed and small, while the potential magnitude of the gain remains structurally unlimited. This constant cold enforcement of risk asymmetry is what makes the system robust, but also profoundly difficult to sustain psychologically, demanding a constant suppression of the deeply ingrained human urge to fight the inevitable probabilistic error. The operator must become a pure executor, detached from the outcome of any single event. This philosophical shift from prediction to execution is precisely where the Darvas methodology transitions from a historical curiosity into a robust, systematic framework. Darvas, working in the 1950s, was an unwitting pioneer of quantitative analysis. He devised a boundary condition mechanism that, when translated into modern terms, functions as a high-fidelity algorithmic trigger. The box itself is simply a mechanical filter, defining a specific consolidation range where price action indicates a temporary equilibrium between supply and demand. It is not a subjective drawing exercise. It is a precise mathematical definition. The highest high and the lowest low recorded over a defined look-back period, provided certain subsequent price action confirms the boundaries. The elegance lies in the objective nature of the signal. The system forces the operator to ignore the prevailing market narrative, the endless stream of financial commentary, and the emotional spikes of news events. These are all noise. The Darvas box filters this noise, isolating the one variable that matters: objective, measurable demand pressure. We can define the Darvas box today as a demand quantifier. The upper boundary is the critical threshold. A sustained breach of this upper boundary, validated by an increase in volume, a tangible commitment of capital, is not a prediction of future growth. It is the verifiable signal that supply has been fully absorbed and the path of least resistance has shifted upward. In contemporary systematic trading, this translates directly into a conditional logic gate. The system asks, if the closing price exceeds the box high and the traded volume exceeds the established moving average of volume, then initiate the position. This is a pure, non-discretionary trigger. The system dictates the entry point with absolute precision. This mechanical approach inherently solves the core problem of human error. By eliminating the subjective decision-making process, the moment where fear or greed influences the button press, the trading system gains its structural edge. The operator is relegated to the role of a disciplined infrastructure manager, ensuring the system functions, but forbidden from interfering with the probabilistic outcomes of any single trade. The objective is not to win every trade, but to capture the positive asymmetry defined by the system. A small, fixed, and statistically defined risk against an open-ended, statistically validated reward potential. The systematic edge of the Darvas methodology is therefore the complete elimination of discretionary action. It is a system built on the premise that consistency and logic, executed flawlessly across hundreds of events, will always outperform the highly variable, emotionally compromised judgment of the individual operator. It is the victory of codified logic over intuitive guessing. This architecture was never about locating intrinsic hidden value. It was engineered solely to capture high-velocity market momentum. The system functions by treating the breakout as a probabilistic entry point, understanding that the majority of these signals will prove to be noise. The statistical edge is derived not from a high win rate, but from profound asymmetry. The Darvas box methodology systematically enforces the acceptance of small, mechanically defined losses, the cost of admission, to ensure that capital is preserved for the rare explosive trend. If the price re-enters the box, the trade is immediately terminated. This is not failure. It is the system operating precisely as intended, filtering false signals without emotional interference. Crucially, the upper boundary, the new ceiling, provides the trailing mechanism. As the price moves higher, the floor of the box is mechanically raised, locking in profit and simultaneously defining the next risk parameter. This ensures that the system automatically maximizes exposure to the signal while minimizing vulnerability to the reversal. Darvas proved that the path to substantial financial gain is not through predictive genius, but through rigorous, non-discretionary structure. It is the cold, objective adherence to a system designed to risk 1 unit to capture 10. The legacy is the ultimate affirmation of mechanical discipline. Profit is the function of systematic execution and the logical acceptance of small, frequent losses in pursuit of the statistically rare asymmetric gain.